Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Today, we welcome back Keith McCullough, CEO of the renowned market insights outfit, HedgeEye. With over 200,000 followers on Twitter, Keith has garnered a global reputation for his transparent, data-led approach. We kick off the interview by discussing how Keith and his team of over 40 analysts use their proprietary growth inflation policy model to paint an illuminating picture of the macroeconomic environment. We also cover current markets, where I highlight the erroneous recession narrative being peddled by some mainstream media, before we unravel it using HedgeEye's unique top-down approach. Keith also makes sense of inflation, identifying the Fed's baffling position before explaining how HedgeEye went long inflation acceleration well over a year ago. Enjoy.
Welcome back to Opto Sessions, Keith. It's great to have you on the show again. So how are all things HedgeEye right now? Markets must be keeping you, like everyone, I suppose, pretty busy at the moment.
Yeah, a nice wake-up call for Monday morning with an alleged global contagion going on. But just business as usual here at HedgeEye, so things are going well. Thank you.
Perfect. All right. Well, I'd like to start by reminding listeners what differentiates HedgeEye's investment analysis from your peers. So why have many of the world's smartest and most successful investors relied on your investment research for over a decade now?
I think you get a different answer from different people. We cover a pretty wide moat of different kinds of investors, but I think the general answer would have two parts. I mean, people pay for our process. It's proprietary, and a lot of people might even call it their North Star or the process that they start with. And the other one, obviously, is results. So you can say you have a process, but if it doesn't help people, make money or save money, then that's not going to be too useful. So, and all of it's really within the lens of a former buy side or hedge fund manager, and I think that that's unique as well, because a lot of research that people get obviously isn't coming from a practitioner perspective. It might be a little bit more theoretical in nature. So I think the actual doing of things and me trading my own portfolio, my own PA, if you will, alongside it, gives people a lot of confidence that I have skin in the game.
Yeah, absolutely. Makes your insights, I suppose, much more actionable than some sort of theoretical based insights that you might get from other publishers. Right, well, let's briefly dig into your investment philosophy then. So you formed the business in 2008, which is an interesting time to start covering markets, to say the least. So what was the eureka moment for you? Like, why found HedgeEye?
I started in the late 90s, but I started HedgeEye obviously in 08. I'd spent the first part of my career on the buy side as an analyst and then a portfolio manager. So 2008, really, that was the moment where it was pretty clear that you could provide people a service that was not available. So again, helping them save their money first. I mean, that certainly isn't or wasn't back then in rule number one of Wall Street or the current, legion of doom, if you will, of fear mongering or clickbait type advertisers that are selling newsletters. They all have their own thing. My thing is to, again, save and make people money. So it wasn't an entirely unique thought. It was actually, I'm still kind of quite shocked that is unique. But again, given all the conflicts of interest out there, this has been a nice place for us to be alongside the people and democratizing, a real research process that real people use. I mean, that's a big thing for the people, if you will, or what we call HedgeEye Nation, is that they just have access to something that they would have not ordinarily seen. And I think that there's quite a curiosity for that as well.
Yeah, well, let's dig into that then. I mean, why was it imperative to become the antithesis of everything that old Wall Street stands for? What were they getting so wrong, and what do they continue to get wrong?
Well, I mean, just in principle, they're wrong, right? Like when you start every day with 90% of your ratings are buy, or your conflicts of interest with your banking clients, or your self-centered interest in collecting a brokerage fee in terms of an accuracy rate. I mean, these are major problems, right? Metaphorically, like, the Berlin Wall could be what it is until it comes down, and then you can see everything. And that's, to me, it's still like when we get down to our founding principles, which are quite literally the opposite of an opaque or an old wall. I mean, ours are transparency, accountability, and trust. And I mean, we take that quite literally to the bank every single day. And I don't think our competition can remotely pretend that is indeed the principles that they stand on.
Yeah, absolutely. Well, your stated aim, I think I read on your website, is to provide hedge fund quality research for individual investors. So we know financial jargon often precludes even highly intelligent non-financial professionals from truly understanding and accessing the potential of financial markets. So how do you adapt the HedgeEye approach to communicate with that audience?
Well, that's been my greatest challenge, and coaching people through it, because we have, like I said, we have a broad moat of people that are paying attention to what we're doing and paying attention to our process and trying to learn it. So you'll have like the highest level hedge fund, mutual fund, pension fund, et cetera, asset allocator on one side of a discussion that I'll have throughout the day, and then on the other side, I'm trying to teach people why that is indeed a better way. And what's interesting is that both communities agree. So, the more I get down to the basics and quite literally define it right down to the screws and define every component to the process, I find a little bit more success, I guess. And again, it's a challenge. It's like anything else. If you're a good player that plays a professional sport at the highest level, that doesn't mean you're going to be a good coach. We've seen that happen a lot of times. So I've sometimes struggled with communicating or coaching, but I also find it like my daily challenge. And that for me is a great blessing, because again, waking up with, God willing, 2 feet on the floor every day, trying to get better at something. And I really want to be a better coach. And I have to coach both the institutional community and the individual subscriber, the family offices, all together at once.
Yeah, absolutely. I wonder whether there's sort of transferable skills between coaching that institutional audience versus the retail audience.
I mean, it's an interesting access point, if you will, where you find them converging, those communities of people. Because again, if you're running a $40 billion fund in Boston and you're running, $4 million, personal account or family office, what's interesting is that both are starting. Well, I'll have those two people watching the macro show because they want to get into the detail of the process and how to quite literally execute in the moment in the process. Everything needs to be timely and topical from our perspective, because there's always a point to execute or not. And what I find is and again, that's humbling to have institutional managers tune into the macro show, because I thought the macro show was just going to be teaching people that wouldn't ordinarily have like a morning research meeting or a morning call internally, but that's quite not the case. So we have a broad and broadening community of people that pay attention to that every morning. So that's really that's my daily challenge, is to try to coach that, not get frustrated, actually, because sometimes, I'm sure you've seen, sometimes I can get a little frustrated because, some of the questions may be a little frustrating, or, the game can be frustrating. It's not like I'm not human either.
No, absolutely. Okay, well, let's cover your investment philosophy, or at least the nuts and bolts of that investment philosophy, because I think that will help set the context for our discussion of current markets later on. So firstly, I'm keen to highlight an important distinction. Why focus on rate of change versus absolute change?
Well, rates of change are mathematical and derived through, the secret to the universe, as Stephen Stovratz would say. Mm-hmm. He wrote Infinite Powers. He's a mathematician, a really good one. He simplifies the complex. But rates of change, calculus, is not subject to opinion. There's not an opinion on valuation. There's not an opinion on the way that the world could or should be. There's no politics. So focusing on just that to start, that is critical, because again, it puts me in a place where I can't be a partisan hack or somebody who's just trying to tell the markets what to do so that it suits my positioning. Again, the rate of change of both the economic data and the rate of change of volatility within my market signals. Those are the two big things I focus on: the signal and what I'm sure we'll get into, which are the economic quads. The signal or the market, if you want to just simplify that, is always front-running the economy and the quads, of course. So I fundamentally believe that I know absolutely nothing, that the market knows most things, and it's my job to catch up to the market and or stay with the market if I'm on the right side of it.
Yeah. Okay. Well, if we think about the momentum within those rates of change, then how do you identify when something's about to roll over? And by that I mean starting to slope off from its peak, or conversely, when it's starting to come up from a downturn. I imagine those are the areas or the interesting sort of points of the trend that you focus on. How do you identify those?
I'll start with what it's not. It's not a breakdown of the 50-day moving monkey or moving average, as you might affectionately call it. And if you just want to look at that, just back test it. How many times have we quote unquote broken the 50-day to the upside in the dollar in the last year and a half, for example, and they were all complete head fakes, or in U.S. stocks for that matter. So I don't do that. That's a single factor model. Okay, it's price momentum. That's it. I use a multi-factor model that is multi-duration. So I have. If you want to think about multi-factor, it's price, yes, of course, real-time price, volume, and volatility, and the volatility of volatility. Those three things are basic three-pack model that I built myself. That's my signal. Then I run it not just on like one duration. I run it on what I call the immediate-term trade duration, 3 weeks or less, the intermediate-term trend duration, which is 3 months or more, quarterly, and then long-term tail risk duration, which to me is inside of 3 years. I don't go beyond 3 years and tell the world, what it can be or should be. What really defines the answer to your question, and it's a mathematical answer, is when the trade, the immediate term, starts to change direction and starts to get confirmed by, is the beginning of a new trend or what we call a reversal or a phase transition from bearish to bullish. And that is almost always a function of what economic quad you're going into, by the way. That's why I'm so sensitive in terms of making changes or not. Patience is quite core to my process. I wish as a younger man I had more of it. But now, I have a lot of people that depend on that. So I have to be patient in points in time where I ordinarily may not be. But I am now. I taught myself that. It's been a great lesson. But again, being multi-duration and multi-factor is, again, I think it's a much better way than the alternative, which would include moving averages, as I mentioned.
Yeah. Okay. Well, market and policymaker sentiment obviously are two factors that go into how you make decisions at those margins, at those points at which the trend might upturn or downturn, as we were just discussing there. I imagine that it's not an exact science to actually analyze market or policymaker sentiment, but is there an extent to which our listeners and investors in general can make that systematic? Is there a process they can follow?
I think so. I mean, and you're not going to get it all right because you are, of course, trying to front run not only the economic data through the lens of a market signal, but you're trying to front run the behavior of policymakers based on those rates of change of growth and inflation or economic rates of change of growth and inflation or economic data. So, getting to that point, but I have thought that through. Obviously, that is my framework. So that's why we call it our GIP model. So again, growth, inflation, measuring, mapping constantly and stochastically measuring and mapping the rates of change of that data and front-running policymaker response. A good example of that this year, obviously for the last year and a half, has been that our model was calling for a breakout in inflation in June of 2020. I mean, that's a while ago. That's a couple of careers ago, it feels like. But, we knew what the response was going to be from policymakers. They would, on the margin, get less dovish and some would get outright hawkish. The Bank of South Korea has done that, obviously. The Fed struggles with just trying to get there. But ultimately, they've been wrong on transitory, and our model has front-run that too. So there's a lot of different ways to front-run the Fed or the ECB or the BOK for that matter. And what really is the data. If I can tell you, and that's really my premise to our institutional clients that really need that. Like, if I can tell you in 3 to 6 months what the economy is most likely going to be, and I do reserve the inalienable right until I live in China, where somebody takes that away from me, to change my mind on that any day of the week if the data changes or the signals, then you would want to know that, right? You would want to know that U.S. inflation was going to 5% when the Fed thought it could barely get to 2%. You would want to know, like in Q1 of this year, when we said short China, we're going to have a nasty stagflation surprise in China and Hong Kong for that matter. I mean, it's bloody well September, and now everybody thinks that that's new news. I mean, so you would want to know these things, but these things were defined by our quad map or a change in the economic condition of the two main factors, the rates of change of growth and inflation, to use those two examples in the U.S. on the inflation side and in China on the stagflation side.
Yeah, okay. Well, let's get onto that quad map, that GIP model now. I mean, can you just firstly explain how you use economic growth and inflation and the marginal rates of change in those two factors to separate the economy into 4 distinct regimes or quadrants?
Yeah, so this is our proprietary model, and when you look at the two factors, those obviously aren't proprietary. How we build the model absolutely is. So again, like I said, so we have 4 different economic quadrants that you could be in. Quad 1 is when you have Goldilocks, basically growth is accelerating on a real basis, inflation is benign. Quad 2 is white hot nominal growth. You have both growth and inflation accelerating at the same time. So for example, our call on that started in November in the US, and we had 3 quarters in a row of Quad 2, which is rip-roaring fun. I guess we backtest everything in macro against that. So in Quad 2, interest rates rip to the upside, high short interest stocks go to the upside, small cap stocks, the crappier the stock, the better. Quad 3 is where you get a toning down of that. So that's economic stagflation, where the real growth rate starts to decelerate because inflation's going up at a faster rate. And then Quad 4 is like what we're known for better or for worse. Quad 4 is when the shit hits the fan, or when you have both growth and inflation slow at the same time, and then the policy response eventually is to bail markets out. So getting in front of that move is a real important move, from a risk management perspective. But it's also really important to not see any market down day as, we're going into Quad 4. That would be the opposite of the way to read the signal, which is front running those 4 economic quads.
Yeah, absolutely. I'm keen to understand as well how you sort of characterize that model internally. Like, is HedgeEye's investment strategy top down, whereby you overlay sector specific knowledge from each of your analysts, which I think you have well over 40 now covering each of the different sectors? Like, do you overlay that information after the macro picture has been established?
Yeah, well, we start with that. Like I said, and for many, it's their North Star. It's certainly my starting point. And investing is much that way. I mean, it's about reducing the probability of blowing up and staying with probable trends that are going to continue. So again, when you take that, so you take all 4 quads and you back test them against anything in macro. And I mean, we do 50 different countries, from rates to currencies, obviously to equities, do commodities fully loaded. And what you find is that each economic quadrant has both top-down asset allocations. For example, commodities work in Quads 2 and Quad 3 because those are inflation accelerating quads, whereas they get annihilated in Quad 4. A lot of things get annihilated in Quad 4 because that's deflation. But it also provides a pretty damn good framework to be neutral. Like, I don't care if I'm making a deflation call or a reflation or an inflation call for that matter, whereas a lot of people in this business, as you know, particularly if they're more of the writing nature and not the portfolio and alpha generating nature, they just perpetually take one view, which you can lose a lot of money for an uncomfortable period of time doing that. So again, we back test it all, then we take it down to the sectors that work in each quad. Then our analysts, who are very well aware of that, take it down to single stocks. So we can back test any stock within all 4 quads. So if you're an institutional client, because you'd have to pay a bunch to get that, you can give me 25 tickers, and I'll give you a report back that tells you what economic quad that stock is going to do well in and or poorly in. And those are really valuable insights because it gives you an awareness. I mean, let's just start with that, right? It's not unlike I think if you think about the weather, Dalio calls his all weather model. Ours is constructed entirely differently from a mathematical perspective. I don't want to go off on the rail on that. But if you have thunder and lightning, your likelihood of dying goes up if you're carrying a 9-iron around in the fairway. We know that. But most people, when they invest, they don't know what A's are or B, what they would do to their portfolio or their stock picks because they're generally unaware. That's where a lot of our clients are like, thank you for making me aware. Now I can get to work.
Yeah, absolutely. That point around sort of coming to you from the bottom up almost with individual stocks, and then you map it back to the different sectors and then the quads that are conducive to strong performance within those sectors. That's an interesting point to identify a quad that a stock performs well in based on its sector is simple enough. But then what other factors do you need to take into account to properly ascertain whether Microsoft is going to perform well in X environment? What other, fundamental indications or factors do you need to take into account?
Yeah, so all factor exposures. So we're indifferent to which ones are correlating with the quad. So again, we let the machine tell us what is working. To use your example, Microsoft. Microsoft is going to work in quad 1, 2, and 3, and it's going to get crushed in quad 4, particularly if it's a nasty quad 4. Mm-hmm. So all you have to do if you're long Microsoft is be concerned about us saying that the probability of quad 4 is rising. What's interesting about Microsoft and a lot of big cap or quality, if you take factor exposures, so just to speak to it mathematically, Factor exposure is like large cap. So when you say, what is the size? What is the factor exposure in terms of size? Is it small or is it large? Quality, what's the balance sheet? So do they have a lot of leverage or no leverage? High short interest or low short interest? Low beta or high beta? So I can go on and on and on. But the fact of the matter is that when you go from quad 2 to quad 3, those factor exposures that Microsoft has are highly valuable. And they're highly valuable and coveted by this thing called the machine. So some people who are that's what the machine's looking for. There are a tremendous amount of people that are running money based on factor-based approach these days. So what you're finding, and in fractal math, you'd call it similar sets or emergent properties. The machine finds them pretty quickly. So they're, real growth slowing, buy Microsoft, sell the Russell 2000. Buy more Microsoft, sell your stupid small cap stock pick. Or now you're going to feel stupid, even though it's a good pick. It doesn't matter. It's not about the picks. It's about understanding what quad 3 environmentally looks for at the factor exposure level. And what you'll find is that the stock's back test will reflect those factors.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Yeah, okay, really interesting. And that Microsoft example has actually helped make it a little bit less abstract. So perfect. Let's take that then and move on to kind of where we are now and what that means for investors. I'm particularly interested to sort of paint a picture of the current environment and then ultimately work out what equities, particularly given our audience, are most conducive to strong performance within that context. So many economists warn that the economic downturn caused by the pandemic is causing a second recession. So a recession within a recession, if you like. I mean, this second recession might be less acute, I suppose, would be an adjective to describe it, but it's more likely to have a lasting and even permanent impact on the labor force and wages at large. So firstly, what's your take on that?
To have a recession, first of all, you have to have negative year-over-year growth, or at least going towards it. And you can have a very shallow recession, but have carnage in the stock market on the way there. What's happened is that we've gone from peak growth, the best growth rates we may ever see, likely we'll ever see in our lifetime, to say, call it 12% year-over-year growth was U.S. GDP growth in the second quarter, to half that in the third quarter. So slowing to a double over the prior cycle's peak is not a recession. And by the way, sticking it in the fourth quarter. So our current nowcast for U.S. GDP in the fourth quarter is 5.82%. So again, just to put that in context, what is 5.82% or slowing to 5.82% growth? I mean, the prior economic cycle peak in the USA was 3.3% in Q3 of 2018. We have plenty of experience, plenty of track record calling economic cycle peaks, recessions, et cetera. So it's not even remotely close to a recession. In Europe, our model has us now casting to from 2% inflation. You had your big cycle peak in the second quarter, then you slowed in the third quarter, but back going from 3% to 4% to 6% European economic growth in this quarter and the two after that. That is not even remotely resembling a recession. That is an expansion. Now, again, I don't think that it has legs beyond that, and that's another career from now for me in terms of making money on it, hopefully. And if you're looking for a recession or something that resembles almost no economic growth on a real basis, you go to China. You can find that there. You go to Japan, you definitely see deflation there. But you cannot, if you want to, you can paint everything one way. That's a really easy way to do this job, and you don't have to work very hard to say stuff like that. But we're right down to the screws, right down to the basis point, now casting every single 50 different economies. And, there's no recession here right now. If there is a recession that starts to develop, that would be more likely closer to the second and third quarter of next year in the USA. All the while, China is going to try to find some. They won't report it as a recession, but it's going to be a pretty nasty cyclical bottom in the meantime. So you have to also get used to the fact that different countries are going to do different things at the same time, which, by the way, is also, if you backtest it, you're going to find that that's actually pretty common.
Yeah, okay, so that's the perfect answer, because my next question is about interpreting this economic data. I think there's a lot of ways that it's done in the sort of traditional investment and finance media that we've kind of alluded to already. And given that third quarter economic growth, for instance, will be compared to Q2, which was a bad downturn relative to history, and if we avoid another wave of lockdowns, Q3 GDP growth should be the highest ever. So to what extent is it a confusing macro picture for retail investors in particular? Like how do they make sense of that? Do they need to look beyond just, quarter over quarter growth or quarter over comparisons, for example?
We use a 2-year look back. So when you look back 2 years, you're not just going to look at the pandemic. What you're talking about are base effects. They're really easy base effects in the second quarter, but they're tougher base effects in the third quarter. So third quarter growth slows against tougher base effects, et cetera. I think what's going to surprise people in the US is that the fourth quarter, despite even more difficult base effects throughout a reopening, you're going to see the numbers go up again. So again, you get the numbers came down in the third quarter, they're going to go back up in the fourth quarter. And that's just the way that we have it. I mean, it's a really interesting question, though, that you ask. How do you get somebody who doesn't do the math or doesn't have a time series? If I had a picture, I'd just show it to you. It's a time series. It shows you where GDP is going from here. It's easier to understand than the sun rising in the east. I mean, it's not that complicated. What complicates things are the way that the media, old wall media in particular, or this new era of fear mongers out there on Twitter and on the internet that get paid for clickbait. What's interesting is that they obfuscate the simplest things, like the sun still rises in the east. You might say you put a frog in a pot of water and boil him that he doesn't notice, but try it. The frickin' thing will jump out of that pot right away. I mean, people believe anything, right? I mean, and that's the other thing in this day and age. And Neil Howe, our demographer, has written extensively about this. People believe what they need to believe. People don't do math. I'm generalizing, but when you said it that way, I do worry for the people because I built HedgeEye for the people to make them macro aware of, again, rates of change that are not debatable points. These are just facts, like the sun rising in the east.
Yeah, no, exactly. I think you've clarified it perfectly. And that's the point I wanted to dig into, because I think when you do look at traditional sort of publications and media out there, they now cast it, I suppose, if we can use that term, but not in the way that you guys do it. They do it completely devoid of any relativity. It's completely an isolated point made without any data or without any visualizations, which I think is difficult for particularly our retail audience to comprehend. But I suppose if we can use that juncture to turn our minds to inflation, administration and Fed officials seem to be telling us that US inflation is under control and even decreasing in some publications I've read. But by their own metrics, this simply doesn't seem to be the case. So are the Fed essentially lying to the market by saying inflation isn't extremely hot right now? And if so, why would they do that?
There's a difference between being ignorant and lying, because, lying implies that and you're just, bold-faced lying about it. I wouldn't put Powell too far off of that line, though, like in terms of what he did at the most recent, pivot. His Fed governors were a little closer to the truth, which is obviously inflation on a reported basis on their own numbers has hit the 100th percentile on a 5-year look back on any definition that the Fed has. So, of course, it's a lot higher than what they thought. To use like Powell did at his last, at Jackson Hole, when he did surprise people with his dovishness, to just anchor on something like used car prices, which is a de minimis component of headline CPI relative to something like rent or human shelter, which is a third of CPI, which is continuing to make new cycle highs and ripping the faces off people that have to pay the rent. I mean, that's not just a lie, that's a disgrace. And I'm not here to help people get excited politically. That's just a mathematical fact. I mean, I don't know what else you want to call it. My job, though, is to just, again, if you want to tell me it's transitory, I'm going to tell you it's trending. You want to tell me it's transitory again, I'm going to say it's still trending in my account. You're either long or you're not long inflation. That's it. You don't have to be Republican or Democrat. You just have to go back to June of 2020 when we told people to buy commodities for inflation and short dollars. And you can look in your account, you tell me if it inflated. And indeed, it's inflated and it's trending. And what we've also seen is a broadening of the inflation. So it's not just oil going to 75, it's natural gas, now obviously rocketing towards 5. And you have a lot of policies out there, government policies that have, you can blame the pandemic all you want, but the fact of the matter is that big policies like ESG or European carbon pricing, which was a joke, I mean, that's created big supply holes in things that the world needs right now. Of course, the government's not going to take any accountability on that. But again, I'm not trying to be their politician. I'm just trying to tell you, if you've been long natural gas, European natural gas is at the highest level ever. I mean, that's a long time.
Mm-hmm. Yeah, okay. Well, so that's inflation covered, and we obviously have already covered economic growth as well. So if we've taken those two factors as part of your sort of top-down macro approach, what quad does that put us in, and what does that mean in terms of an asset allocation perspective for individual investors?
So when you have inflation accelerating, there's only two quads you can be in, quad 2 or quad 3. right? So China's in quad 3. China is completely screwed because they have, on the growth side, they got huge demographic problems with negative population growth in their core spending cohorts. They have the one-child policies coming home to roost, obviously. They have an industrial recession that's developing on the top-down view as well. And they have real inflation accelerating. So they have they're different kinds of quad 3. That's the bad one, okay? And that's consistently been our call since the first quarter. Then you have places like Hong Kong, which the Chinese quite literally couldn't care less about, that have to deal with the market effects of that. So we're still short Hong Kong on that as well. But quad 2, like Europe's going to realize in the quad 2, which Europe will realize in the fourth quarter, and a rising probability that the USA goes there. You can still be long commodities, but it's a much more buoyant stock market because we're talking about, quad 2 is the mecca. You can be long growth and inflation and make money both ways. So, quad 2, obviously that's where stocks like GameStop came to be. But again, not a surprise. You should not have been high short interest stocks going into quad 2. And I don't think people should be this time. I think that's a very dangerous place to be, especially with market sentiment where it is. In the US, market sentiment is god awful. It's net short SPYs. There's huge implied vol premiums in the options market. On every quote unquote correction, even though it's only 2 to 4 or 5%, people lose their minds. And you could see that in the options pricing and the positioning. So I do think that the US rally will be more exciting, if you will, than another rally in Switzerland. It's been a great place to have your capital, but it's still Switzerland.
Yeah, okay. Well, when it comes to that US rally then, in regards to equities, which sectors should investors look to be in as part of that sort of environment?
Well, I just stay with what we have that works in both quad 2 and quad 3, right? It's more what you get rid of. So again, we're coming from quad 3. So in quad 3, we were long tech. The top 3 we had were tech, REITs, and utilities. Yeah. And when you go to quad 2, you get rid of utilities because interest rates are going up. You get rid of your gold. So again, in quad 3, by the way, for gold people, I prefer people be gold people that can go both ways, by the way, long and short. That is being a much more, some people that are long gold feel quite intelligent, quite sure of themselves. Stop that. You'll lead a better life, a better risk managed life, and you'll make more money and save more money if you just go both ways on gold. Understand that there's one quad the best quad to be long gold in is quad 3. We just came out of it. It was a better quad 3 in August of last year into September when it peaked. It had an 18% drawdown because we went into quad 2. So now, getting out of gold, getting out of utilities, those are important pivots. Adding, I guess, on the U.S. equity side, adding more beta or more small cap, mid cap exposure is another way to think about going to quad 2 from a factor exposure perspective. Because in quad 3, small caps are short, and they obviously just were miserable places to be throughout quad 3. So these are things that we're thinking about. We're actually going to walk through it on our macro themes presentation later this week.
Yeah, great. Okay. Well, we'll tune in for that one then. Final question on equity markets as part of this inflation perspective then. All-time highs were hit by the S&P 500 and the NASDAQ earlier this month. So can we give listeners an idea of when we're likely to retest those levels?
I mean, if you look at just a volatility adjusted return. So again, if I take the VIX back towards 15, I can get the S&P up 9% from here. So that would obviously obliterate the prior all-time high, which was established in the first week of September. Again, I don't do price targets based on some bullshit evaluation of valuations. I use volatility. If volatility goes from where it's trading today, which is 25 to 15, 9% higher in the S&P 500 is a very conservative estimate. That's closer to 27 or 47.50, I believe, in the S&P 500. And I think that's an important thing. At least entertain the idea. I've done it. I've always done it that way. I don't give price targets. I change where the price can go based on what the volatility is doing. And that I think it's a very it's a safer way to deal with uncertainty. The worst thing you could do in a market is be certain that your price target is right. Imagine that you wake up every day and my S&P 500 price target is 4,500. And no matter what happens all year long, you're just going to say that till you're blue in the face and try to keep your job. I mean, that's terrible. I mean, it's a terrible way to live. Why don't you just wake up every day, like I said, God willing, 2 feet on the floor, 2 hands on the keyboard, and say, oh, if volatility goes here, the price is going there. I mean, that's a lot easier way to do this. And you're going to be much more accurate doing it that way too.
Yeah, absolutely. Okay, well, let's finish then by discussing quad 1. It's one that we haven't discussed so far. We've covered 2 and 3 and 4 to a lesser extent so far. But we've got a lot of equity investors listening in, and I think they'll be keen to kind of know when economic growth and low inflation is there, and kind of when that might be likely to return, I suppose. So when do you think we're likely to see another quad one environment? What key macro developments need to transpire before we see another quad one environment, do you think?
You're going to have to blow things up again. You're going to have a quad four hit, and a quad four gives birth to a quad one. So and that's, again, it's not a history that people don't know. It's the 1980s in the USA. It's the 1990s. Between 1993 and 1999, again, during like a prevailing or a more pervasive quad one environment, what was happening was that the dollar was strengthening, commodity inflation was low, real growth was Goldilocks. But you had to come out of the 1991 recession to give birth to that 1992, 93, all the way to 1999 move. By the way, same thing with the 1980s, 1983 to 89, not to go through the whole encyclopedia of cycles, but I think it's important to remember them. That was born out of the stagflation of the 1970s. So you have to, the inflation that we have today, it's a cycle of inflation. Again, if you missed it, too bad. If you're still long it, well done. We're not going to stay in that forever. I don't need to write a book to try to be famous on that's going to be forever. That's ridiculous. That's one way to not be famous, and I don't try to be famous anyway. But this inflation is going to give birth to a deflation, and timing it right is the most important thing that I'm striving for each and every day. And again, timing it means that you stay with it until it's not there. And I do think that Q2 of next year, from a much higher level, oil price could be at 85, 90. S&P, I just gave you the levels it could be at. It could be a lot higher than that. And then the probability goes up because you are closer in time and space to the economic quadrant that is quad four, which is Q2 of next year. You're closer to the catalyst, and you're from a much higher level. And that's the way that I see it.
Yeah. Okay. Well, remind us then which sectors are likely to perform well in that Q1 environment when it eventually does transpire.
Well, quad one is like quad four or quad one?
Quad one.
Quad one is basically being long real growth. So it's the same, almost the same as being long quad two without the cyclicals. You're still long tech, any organic growth, still long consumer discretionary. You would not be in quad one long like some kind of an inflation play, like a basic materials or commodities. Quad one is, of course, disinflationary. That's why real growth, humans really like quad one, right? Because they get to keep the money. That's the whole point. And again, you can make this till you're blue in the face. I just did. Whether it's the 1980s in the US or the 1990s, the case for a strong dollar and low cost of living on a real dollar adjusted basis, Europeans should try to figure that out too. I mean, it works. It has worked historically. It's just something that, with the current money printing environment and the politicization of it all is still unlikely until we get to the other side. If we make a quad one call, I'll let you know.
Great. All right. Well, one for the listeners to watch out for then. Okay. Well, I think that's a nice place to end the main body of the interview with a kind of foresight and outlook for the next, I think we covered the next couple of years there. But let's finish with our quick fire question round. So this is a more general list of questions that we ask everyone that comes on the show. Feel free to answer in as little as one sentence or even one word if you like. First question, and this isn't always an easy one, but I'll ask it anyway. What is the top mistake investors make, do you think?
They stay with losers for too long. They ride their losers.
I agree with that. And okay, question 2. Where do you go for investment or economic insights? Do you read specific publishers, for example?
Only read publishers for contra indicators.
Question 3. What is the most memorable moment from your career to date, do you think?
Getting fired on November 2nd, 2007.
Wow, yeah, that's going to live in the memory. Penultimate question, a top tip for your younger self. So if you could go back in time, what bit of advice would you give to yourself?
Be grateful for the people that mentored me, and be more patient. Those are real important things that I think you just learn with time and space, or some more maturity. If I had it back then.
Yeah. You mentioned patience at the top of the interview. I think that's really important. Question 5 then, and the last question. This is sort of the Opto question. We aim to speak to people that have a differentiated approach. Ideally, the people that are outperforming benchmark returns. So, on that basis, what is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
Making the turns, making the turns, the cycle turns, or if it's a single stock situation, making the turn from bearish to bullish. Obviously, if you can find a bottoming process or a topping process for that matter, making the turns whether it be in an economy or in a stock. That's what differentiates the greatest returns, and certainly something that you can't you don't always get right, but it's certainly something you should strive for.
Yeah. Okay. Great. Fantastic. Well, I think that's a lovely message to end on. Thank you very much for joining us on the show, Keith. It's been a real pleasure.
Yeah. Thanks for the conversation. I appreciate it.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.
Co-Fruition.